Welcome back to the Expert Loser, your no-nonsense hub for trading information. Today, we're diving deep into the world of momentum trading. As a momentum trader, you're like a sailor who chases storms. You understand that there's risk involved, but your destination is far away, and you need the strength of the winds to help get you there.
Why stir in the water when you can ride the big waves?
You're not interested in average price movements. You're looking to get in when huge moves are being made. Big swings in the market produce waves of price action you use to sail to profit land. That means you want volatile markets and gravitate towards stocks with strong catalysts, recent earnings, and pre-market gaps. You're generally not as worried about the asset type, name, or sector. Strong price action and market participation is what gets you hyped. Your offensive rating is a solid 8 out of 10. You have the potential to generate large amounts in strong markets. You're okay with losing more often than you win because the wins more than make up for the losses. It's a high risk, high reward game that you're willing to play. Your defensive rating is a 3 out of 10. In consolidating range-bound markets, careful risk management is your anchor. Now, when I say anchor, I really mean anchor. I mean just stop. Don't trade range-bound consolidating markets as a momentum trader. Time your entries well to avoid sudden price reversals. Be cautious with your signals. Markets often signal strong momentum in one direction before reversal happens. The good old stop hunt. Your mobility is 4 out of 10. Not every market has strong momentum, so you gotta know when to fall back. Trading too often can lead to losses, lots of losses. Stocks with strong momentum can halt or reverse suddenly, as we mentioned earlier, so choose your entry and exit points with precision. You can avoid too much damage with a tight stop, but you risk being taken out of the trade as price fluctuates. Momentum trading is all about capitalizing on the continuation of an existing market trend. It's not about predicting market direction, but rather identifying and jumping on trends already in motion. The key here is identifying and entering trends early enough and being able to exit when you sense momentum fading. Indicators like moving averages, relative strength index RSI, and MACD can help you gauge the strength and sustainability of a trend. You really don't want to rely on any one factor or indicator though. You would rather have a few things that you can rely on to give you an idea of what can happen. Pay attention to trading volume. High trading volume during a momentum move indicates strong market participation, increasing the likelihood that the trend will continue. Here's an example in paper trading how you can use momentum to your advantage. You'll notice here AMD trading within a range. Outline the range so you can keep an eye on it. As price moves, you want to observe instead of anticipating. Wait to see what happens. Here you see a powerful momentum bar breaking the range. A natural reaction here is buy, it's going to the moon. But honestly, you shouldn't buy here. You should wait for a retracement. Since price made such a large move, it's natural for people to take profit and sell. You want to see how buyers react to that. You also want to have an idea of where you can place a stop. Here you can see people are starting to take profit. How do buyers react to that? Do they allow price to dip all the way back to where it started? Do they allow it to dip more than 50%? That can give a clue about what may happen. Right here we see it's less than a third, so it looks pretty good. gets to about a third, and then gives me a strong momentum candle, which is this big green candle here. As I get this momentum, I buy right away. I see it does another little dip, I add another contract. Now, as it dips back, I start thinking about my stop loss. And I say, to protect myself, I'm going to place my stop right here underneath where I entered the trade. Ideally though, you should set your stop loss right away. Momentum moves very fast and you do not want to get caught in a sudden reversal. But here we can see the trade is working in our favor. This is when you can start thinking about negating some of the risk. As you can see, I'm moving the stop to underneath where I bought the second contract. And this ensures that if I do see a reversal, that I'm not going to take a sudden large loss. At this point, the trade is paying for itself. I see I'm up over $5 from the entry point. So I move my stop to secure around $2. The stop here is not selected randomly. The logic is that when you see a swing low and a powerful candle right after it, that swing low then is verified as a reference point that the market felt, okay, we could buy from here. As price pulls away, you definitely don't want to leave your stop all the way down here. After such a crazy run, I can't blame you for just taking profit and being happy. But if you want to see if the trend can continue, a good way that I've found is to use the 20 moving average. 20 moving average is a good indicator of a trend change. A break below it can sometimes tell you if a trend will be respected or not. As you can see here, I saw it dancing around the 20 moving average but not making a significant break. I decided to add a contract and raise my stop to right under that swing low. Now in this case, the 20 moving average is still being respected. And you can see you're getting a nice bounce off of it, increasing your profits. This doesn't always work though. You can end up having a break of the 20 and a hit of your stop and losing some of those gains. But again, if you're in it for that home run, this is a good way to play that without being too reckless. Keep in mind though that this is paper trading, and I selected this particular day to show you an example of how momentum trading can work. Do remember the example from earlier in the video of how momentum trading can fail terribly as well. Momentum trading isn't limited to bullish trends. Learn how to spot and capitalize on both upward and downward momentum. In fact, bearish momentum is often stronger than bullish momentum. Fear has a way of feeding into itself and causing extreme behavior. At this point, you may be asking yourself, okay, how do I find these stocks that are experiencing strong breakouts or that are consolidating and may potentially break out? Well, there are a lot of ways. There are tons of paid and free options for stock scanners and screeners that you can find. Just do a Google search, should be good. One of my favorites though is Finviz. It's free, so I can get with that. I think they have some paid options that give you a whole bunch of extra stuff. You can go for that if you like, but the free version does a great job for me. I'll go more into detail about how to use this and other free resources online in another video in the future. Another thing you can do is pay close attention to stocks that have been consolidating for a while. When a stock consolidates like that, it's sort of building up energy, ready for a strong move. Buyers and sellers are building up positions, so a strong initial move from a consolidation usually has some follow-through. Set notifications for when the price breaks the range. That way you don't have to watch it all day. Once you get that notification, observe price action and see if you'd like to participate. You ideally want to trade when you see strong market volume and price action. Focus on the market open and close, and try to stay away from the slower midday hours. Keep an eye on assets that are consolidating. Set notifications for when they break their ranges, and use volume, price action, and market sentiment to give you an idea of how far things can run. Use manual or automatic trailing stops to help keep your risk under control, Take profits when it's reasonable, and try to leave a small portion in the trade in case momentum keeps going after you take profit. Playing the momentum card can lead to some pretty nice gains, but be mindful of the risks. Like a sailor in a storm, high volatility markets have greater risks. Understand market behavior to know when playing the momentum is wise. Remember, it's not about jumping any wave in any direction. It's about chasing the biggest waves and riding them with skill and strategy. If you found this video helpful, don't forget to like, subscribe, and hit that bell for more exciting trading content. Until next time, happy sailing, and may the momentum always be in your favor.